Hey folks, David Frost, mystrategicforecast.com, here for another episode of Common Sense Technical Analysis. Thanks for tuning in. Today is Thursday, June 19th, 2014. Here's your daily chart of the SPY, and basically, as I said yesterday, we had a little bit of a retracement, about a third of the move from yesterday, early in the day, and then we had the float back higher, which is typical for the, once again, light volume markets, and in light volume, we can expect to float higher, and that's exactly what we got. But as I said yesterday, we did retrace a little bit of the move from yesterday. This is options expiration. It's quadruple witching options expiration. So tomorrow, you can expect some whipsaw action. You're going to see some up, you're going to see some down, and I really wouldn't be surprised to see it finish close to the flat line. It does that a lot on Fridays. You'll have some buy programs, you'll have some rebalancing taking place, you'll have some baskets of ETFs rebalancing and all that kind of stuff. So there's a lot of gyrations in the market. So if you're trading tomorrow, you have to be careful. It's not for the faint of heart, usually on especially quadruple witching options expiration. But that's about the ball game for today. And in fact, let's just take a look at the intraday chart. Here's the 10-minute chart of today's action. And let's see, let's see where we go from here. We have the start of Thursday right here. We start and we go down, and then this afternoon we go back up, and that's typical for an options expiration. This was about 1/3 of the move retracement from yesterday, and not surprising. Let's just see for kicks if it was about 1/3. We'll do a fib retrace from the low from yesterday, and where are we? Yeah, it's close enough. Close enough for government work. 38.2 is here at 195.76, and the low today was 195.80. That's close enough. That's about a third, and then we went back up. And that's what I was talking about last night, third to half retracement, and then we go back up. That's exactly what happened. Again, this is not rocket science. This is not mathematical all the time, fancy numbers and fancy squiggly lines and all that stuff. A lot of it's just common sense. It happens all the time. When it happens all the time, you take notice. And I have a big notebook of this stuff in it, and that's how you develop a format over time of things that continuously occur and reoccur again. And we know that the market has symmetry, and all these things factor into the common sense end of the technical analysis. So let's move on, and let's talk about, well, I know everybody's waiting to hear about gold, so let's go right over to gold. And gold had a super spike today. Let's go back to the daily chart. And on the super spike, the GLD was up 427. It was up over $5 at one point. The price of gold futures contract was up. I think it finished the day up $45. And that's a huge move. So here's the deal. So I've been telling you that 125 was my upside target for this particular time frame, this move. So that it blew right through all this resistance right here, which I didn't think would happen. But that's the markets, folks. I mean, that's why we weren't in the trade. I said the long, I didn't see much upside, so I didn't see this coming, obviously. Nobody did. And I thought there was downside potential, so we didn't take a trade. But here's what we've got. Now we have a big up move. Now, I would expect to see a retracement of about half of this up move. And if we get a nice pattern, a sideways bullish pattern to trade off of, we're going to take the trade. So, there's always a trade around the corner. We didn't catch this one. Normally on a move like this, you would have had to see weeks of sideways consolidation like this. It happened in 4 or 5 days. That's not typical. So what you're hearing on the gold front is you're hearing whiffs of inflation. Yellen is going to be dovish. They're going to do whatever it takes. Now, if that was the case, since she talked about all that yesterday, you would think that since everybody heard the same information yesterday, gold would have went up yesterday. So really, that's not the reason. That's more of the excuse it was up today. Nobody knows the reason. This morning, it was central banks repatriating gold. That's nonsense. Who would even know about that? Nobody would know about that. So that's just another made-up story. And frankly, what happened is gold started higher. You had a short squeeze. You had some technical levels breached. You had some buy programs put on, or you had buy stops put on from people that were either short or wanted to go long above a certain number. And it self-perpetuates. And as it gets stronger and stronger throughout the day, more people jump on the bandwagon. Buying begets buying, selling begets selling, and that's exactly what happened. GLD had huge volume today. The volume was, what was the day's volume? What was the volume? I'm sorry. Volume was almost 20. It was 24 million shares, and normal circumstances is about a quarter of that. So basically, on strong volume, blow through technical resistance, you're above the 200, the 50, and the 20 period moving average in one fell swoop. Well, you were above the 20 anyway, but the 50 and the 200 in one fell swoop. So this was just a gap and go, and you'll probably see a pullback within the next few days. And if the pullback lasts, let's say anywhere from a week to a week and a half or so, then it's probably setting up to go much higher, and we'll play it that way. We'll see what happens. So that's my take on gold. Wish we were in it, but we weren't. That's how the market works. The market is designed to catch us by surprise a lot of the time. But we're going to catch the trade, no doubt about it. Let's go over to oil, and this is the USO. And the USO is still grinding around, and there's nothing wrong here. This is going to go higher. I think we go to the 39.50 to 40 area on the GLD, coinciding with the 110 on the crude contract, and 109.50 maybe on the crude contract. And from there, we'll see what happens. But certainly, there's going to be a sell in oil, just like there's a sell in the market. It's coming up, but it's not here yet. I will let my members know exactly what I think when I think it. But it's coming. It's just weeks away. It's not here yet, and so we have to be patient. For now, we can play stuff on the long side. Short side is tough, but we can certainly have equities on the long side to play for swing trades, and we've been doing that. Members have been getting their swing trade alerts, and we've been making money. So there's no problem here, but these are my take on the markets. Another interesting tidbit today was the interest rate market. Now, here's the 10-year. Now, let's look at the intraday 10-year. All of a sudden, okay, at 1 o'clock in the afternoon, the 10-year takes off, and it goes higher, and then it pulled back at the end of the day. But this is just consolidation. This is setting up to go even higher. But nobody should be surprised. Why? Because I told you guys at least a dozen times over the last couple of weeks that the 10-year is going to go at least test this high here at 265, 266, and then probably overshoot a little bit, so 267, 268. That's the number I was looking for. Now, here's the 30-year, and we all know the same deal. I was looking for a minimum of 350, this top here, okay? 350, 351, potentially up to, let's say this top here at 353, 354. And so nobody should be surprised because I'm in the TBT trade, which is the opposite of interest rates, right? It's shorting the bond market. So as interest rates go up, okay, the bond market goes down and TBT goes up. It's twice inverse the TLT. And if we look at the TLT today, and then we'll take a look at the TBT in a second. If we take a look at the TLT, here's the down day on the TLT, right? Let's look at the intraday on the TLT, and you'll see the big dump out, right? Look at this dump out. Oh, man, that's going lower, no question. So now if we want to look at the intraday of the TBT, you'll see the opposite effect. This looks like the interest rate chart, right? Little sideways consolidation, a rocket up at 1 o'clock in the afternoon. Okay, there we go. Nobody should be surprised. These are the type of swing trades that I provide the members. The members got this one. I just gave this one out to the public because I like to talk about it because I knew what was going to happen. It was a very high probability trade. So it's easy to talk about it for a week or two while it's playing out. And that's exactly what's happening. So this one's playing out. Anything else we want to discuss tonight? I think that about covers it. You had, well, let's just take a look at one more thing. Your VIX is still at about 10.5. And remember, when the VIX dropped below 10, I said you could start to, nibble away at the VIX a little bit. Well, it came right back in. It's not below 10 yet, but it's close. So, here we are. And, I'm sorry, I think it was below 11. It was 10.99. So we actually did break that today. Yeah, here you go. So here we go. I mean, this is the time to pick up insurance. That's what the VIX is. The VIX is insurance, or options are insurance on stocks, right? The VIX is an indicator of how the options are doing. Is there fear in the market? Are the option prices inflating, which means that when option prices are inflating, there's fear in the markets, there's downward pressure in the markets, the volume picks up, and the VIX goes higher. And that's why I said when you want to buy insurance when the price is absolutely the lowest possible. It's like a long-term care policy. You don't want to try and buy a long-term care policy when you're 75 years old. You want to try and buy it in your 40s or 50s when it's real, real cheap. Now, I understand you pay for it for a long period of time, but God forbid if you ever need it, when you're 75 trying to go to buy one, you're probably going to pay, $15,000 a year. Some people just can't afford to do that, so they don't buy it, and then they need it, and it's a shame. So nevertheless, buy insurance when you don't need it, which is when it's most or least expensive, and that's the idea. So I think on that note, we'll leave it there. David Frost, My Strategic Forecast, common sense technical analysis. Thanks for tuning in, folks.